So last month, the Bank of Canada dropped their overnight lending rate from 2.75% to 2.5%, and another announcement's around the corner with the markets betting on another interest rate cut, but we're going to see what happens and how that plays out on October 29th. Now, we all know when the Bank of Canada makes their announcements, this directly impacts variable mortgages, and you've probably heard this saying of when rates go down, prices go up, but rates have been trending down since last summer, and the market still feels sluggish, so what gives? Now, in this video, I'm going to break down three key things. First is how interest rates and market trends actually interact and why prices have not taken off the way that many have expected when rates have come down. And secondly is why perspective matters. And third is the advice that I would give if you're a first-time homebuyer or seller in this market. Now, before we jump in, my name is Alice Prince. I am a real estate broker here in York Region. I help many buyers and sellers make sense of the market. And my goal is to put things into perspective. Whether you're buying or you're selling or you're just curious about what's going on, I'm here to break down things and to help you see the bigger picture with real numbers to support it. So let's put things into context. Take a look at this graph. I love this graph because it shows the correlation between rates and prices. The blue dots are the rates and the red dots are the prices. And I'm going to show the entire GTA here because it's important to take a step back and to see the market as a whole. People often move between cities all the time, and what happens in one area can impact another. You know, a buyer leaving Toronto might end up in Vaughan, or somebody priced out of Richmond Hill might be purchasing in Newmarket. All of this happens. So seeing the full GTA helps you really understand how everything's connected and will give you a better perspective when you watch updates about York Region on this channel moving forward. So the overnight lending rate was at 0.25% at the onset of COVID and stayed too low for too long, and prices we know reached historically high levels. February of 2022 was the absolute peak of the GTA market, and if we continue down that path, who knows how much more pressure our marketplace could have took. But in March of 2022, the Bank of Canada said, okay, enough is enough, and they started to raise that overnight lending rate. And we've seen prices come down for about 5 months straight till about June. But here's where it gets interesting. In July of 2022, the Bank of Canada put their foot on the gas and increased their rate by an entire basis point, where previously they were only increasing rates slowly and steadily by quarter basis points. Subsequently, of course, that shocked everyone. However, look at prices and how they reacted till about November. They kind of held their ground. Now, granted, it does take a little bit of time to start feeling the impact of higher rates. But then in December and January, we've seen a seasonal downturn, which we usually see every year anyways. And then from about January of 23 till about May of 23, when rates held, prices started to increase again. Then the rates held steady from about July of 23 to about May of 2024, almost a full year, and prices sort of bopped along here and there, obviously with seasonality of our marketplace. Now, we all know we have a spring and a fall market here, which is usually high season for real estate, and then the market kind of tapers off in the summer and the winter. So now we're in June of 2024, and we start to see rates come down with our first rate cut of a quarter point. And I think at this point in time, people are starting to feel exhausted with life in general and how expensive just everyday life is getting. We've seen a small rise from August to October before prices start to drop again. Now, keep in mind, many people are obviously gearing up for holidays. Life is expensive, but us Torontonians are resilient, so we continue to push through here. But make note that it does take a while for the herd to catch up to what's going on with rates and such, and we start to see that really play out as we enter 2025. Prices were slowly increasing month over month till about May. Now, the onset of 2025 was looking promising. There was a very small moment in time here where we could see that we were starting to build a little bit momentum. Rates were down substantially, prices were at decent levels, and the whole when rates drop, prices go up started to kind of overlap and take place. But then the dreaded T word started floating around, and now we're in a tariff war with our friends in the States, which is a huge piece of the puzzle and one of the 7 key factors that influence real estate prices. Economic factors and global tensions play a huge role when it comes to consumer confidence. So this black line that you're seeing here is really just a baseline that helps us see how prices have behaved since the market has peaked. We obviously saw a sharp correction, or many people would call it a crash, from February till about June 2022, but prices since then have mostly hovered around this line. Now, what I find interesting is that even even with everything that's kind of going on and, the lack of sales that we're seeing, home values have actually spent more time above this baseline than below it. And that shows that the market has held up better than most have expected. Obviously not fully recovered at all, but finding a level of stability and balance after that initial drop. But interest rates are really just one piece of the market housing puzzle. And if you want to understand what actually drives home values and do a deep dive into that, there are 7 key factors to consider. Now, not all 7 have to be firing off at once. Sometimes it's a combination of a few that really move the market, but together they do tell the full story. Now, these 7 key factors include population growth, economic conditions, ownership affordability, investment activity, replacement cost, consumer confidence, and housing supply. And if you want to learn more about each one of these, you can download a free copy below. Just enter your email and I'll make sure it ends up in your inbox. Now, it's easy to look at what's been happening over the years and say, oh my gosh, this is absolute chaos. And honestly, I get it. The numbers, the charts, the headlines, they can look pretty stifling and scary at a first glance, but I think a lot of people forget what real estate actually is and what it's meant for. Now, real estate isn't supposed to be a quick flip or a short-term gamble. Now, we know that the real estate market goes through cycles. It always has, but when you zoom out, real estate has consistently proven to be one of the most reliable ways to build long-term value over time. Keyword being over time. So let's put things into perspective here, because there's always going to be strong years and there's always going to be slower ones. But out of the last 45 years, prices have only dropped 10 times compared to the year before, and 7 of those were actually in the early 90s. So that means that prices have gone up 40 times. Even when you factor in the dips and the blips and all that's been going on, the GTA has averaged about 6.3% growth per year. The key is not to buy unless you plan to hold for at least 5 years or more, and historical data has shown that even with all the ups and downs, real estate has rewarded people who take a long-term approach. That said, I don't see home values rising drastically from the peak of 2022 anytime soon. I think what we're going to be seeing moving forward is a gradual, steadily recovery and growth, and that's actually a good thing because it's more sustainable long-term. But until inventory levels start to come down and buyer demand starts to pick up, it's hard to expect any major price jumps. Now, before I go any further, I just want to be clear, this is not a video to convince you that now's the time to sell or to try to make the market sound better than what it is. It's really for the people who are seeing these headlines and are thinking that the sky is falling. Because when you actually look past the noise and you focus on what's really happening, things start to make more sense. And I get it. It's easy to look at the economy, the headlines, and all this stuff, interest rates, and yada yada, and everything that's going on, and to think, oh my gosh, this is a terrible time for real estate. But it's not that black and white. Whether this market makes sense for you really depends on your goals and your situation. If you're someone who needs to sell for a certain number, maybe to afford the next place and still have maybe some money in the bank left over, then yeah, this might not be the market for you. Prices aren't climbing, competition is where it wasn't a couple of years ago, so if your plan only works at the top of the market, it might make more sense to wait until things shift. But if you got some flexibility and the means to make a move, this could actually be a really good opportunity for you. There are way more homes on the market right now, which means more choice, more negotiating power, and less pressure to rush into something. Buyers finally have options again. You're not competing with 5, 10 other offers anymore, and you might be able to actually find a home to buy something that you would have been completely priced out of during the peak of the market. The key, I think, to this market is to look at it through your lens, not through the headline or the numbers that are taken out of context. Everyone's situation is different, and until you start exploring what's possible, you won't really know where the opportunities are for you and what's available to you. Now, when people say, oh, Alice, the market's down, my question is always, well, compared to what? Because if you bought your home 10, 15, 20 years ago, chances are you're sitting on a lot of equity. And yes, prices may be lower than where they were a couple of years ago, but that also means the home that you really want to move into is also worth less too. So is that really a bad thing? Although you might be selling for less than what you could have gotten back in 2022, you're also buying for less than what homes were selling for in 2022. And that difference matters even more when you're moving up the property ladder. The higher priced homes have come down way more in dollar value than the entry-level ones, so in many cases, you're improving your position by making that move now instead of waiting. Because here's the truth, time in the market does matter. And if you're someone who bought during the absolute peak of the market, it's important to remember that you're probably also sold during that peak of the market too. So yes, prices have adjusted, but it's all relative. Thinking, well, Alice, my mortgage is so high, everything feels so much more expensive right now, I'm really struggling to keep up and make my payments. And I completely completely understand. And my advice would be to talk to your bank or your mortgage broker, because I've had clients reach out to me feeling the exact same way. But once they spoke to their lenders, they found that they had options available to them. Some were able to restructure or lower their monthly payments based on their situation. Of course, everyone's circumstances are different, but it doesn't hurt to have that conversation and to see what is available to you. Anyone who bought in the last few years has seen how quickly that the market can shift. We went through one of the most intense periods of growth and corrections in recent history. So if you bought near the peak in 2022, it doesn't necessarily mean that you'll lose money. It just might take a little bit longer to see that kind of equity growth that you're hoping for. We know that real estate rewards time and patience, and the markets eventually correct and recover. For those who bought in 2019 or earlier, you're likely sitting on a decent amount of equity right now, and if you're thinking about moving up, this can still be a great time for you to do it, because money is made on the purchase, not the sale. Now let me explain. Your profit doesn't start the day that you sell. It starts the day that you buy. When prices are lower, you're giving yourself more room for equity growth as the market improves. Paying less upfront often matters far more than trying to time the perfect moment to sell. As values rise again, that appreciation becomes your gain. The difference is that properties are taking a bit longer to move because buyers finally have options again. There's so much to choose from, and while there's around 29,000 homes on the market right now, roughly a third of those are condos, and not everyone wants to fit or can move to a condo. So even that 29,000 number can be misleading, and of course that accounts for the entire GTA, not just one city or one housing type. If you're a first-time home buyer and have the ability to get into the market, I would start exploring the options and figure out what it would exactly look like and what it would actually cost you to own versus rent. You might be surprised by the numbers. If you feel secure in your job and your income is stable, this could be a really good opportunity to set yourself up for the future. Even if home values don't rise for another year or two, think of it as a forced savings plan that you're paying yourself, building equity, and your home becomes your piggy bank instead of paying the rent and getting nothing back. Now, if you're a homeowner on the fence about selling and buying, and you're thinking, my home is only worth 1.1 million and not the 1.2 I was hoping for, my advice has always been to make a move when it makes most sense for you, but here is something to consider. York Region has been in a buyer's market for quite some time now. We've gotten a lot of inventory on the market and many people who need to sell before they can buy, and this has created this sort of bottleneck situation. Homes taking longer to sell, and as a result, inventory keeps stacking up. We're now seeing inventory levels reach points we haven't experienced in years, and when that happens, it usually means downward pressure on prices. And I get it, as a homeowner, you want to make sure you're not leaving any money on the table. You spent years taking care of your home, investing in it, preparing it for sale, all these things. So to hear that your home is worth less than what you thought can really be discouraging. And it's natural to want to wait it out, hoping that prices will bounce back. But the reality is that high inventory, slower sales, and weaker consumer confidence aren't the conditions that are going to drive up prices. Recent trends have shown only modest rebounds, and each year since 2022, we've seen less momentum than the year before. So right now, the odds of prices jumping up significantly in the near term are very low. If you're waiting for a higher sale price, ask yourself, are you willing to risk selling for less later for the chance at maybe a slight bump now? Keep in mind that if you're selling in this market, you're likely saving money on the purchase, and we know that that is where the money is made. Something else to consider and to remember is that all it takes is one neighbor to accept a lowball offer because they're under pressure to sell, and that now becomes the new comparable for that area. Every sale resets the bar, and in this kind of market, many times buyers won't pay more than what the latest sale suggests. You really need to work with someone who understands not just the data, but also the psychology of buyers in your area, and someone who can help paint the picture of what the market's doing to the other side. I do a lot of business in both Durham and York Region, and the mindset between buyers in those areas can be quite different. Now, quick story here before I kind of wrap up. I sold a property in Durham where we received 4 offers, which in this market was incredible. We weren't playing the offer date game or underlisting the home to drive attention. There was none of that. We were actually priced slightly above market expectations actually, but still realistic. 3 of those offers came in below asking, classic lowball offers from buyers based on one recent sale, and I knew that that was going to happen going into this, and that was going to be the case. So I had already prepped all my charts and built my case. Thankfully, I was able to work with a buyer who understood that that one sale didn't define the market, and we ended up selling for $75,000 more than that comparable. The point is even in a slower market with the right strategy, preparation, and understanding of the data, you can still achieve great results. Having the right strategy and someone who knows how to interpret the market properly can make a big difference in your results. Whether you're buying your first home, selling, or just trying to figure out and make sense of what's going on, don't base your decisions on fear or headlines. Take the time to really understand the facts, talk to someone who really knows the local market, and make the choice that feels right for you. Because in every market, there's always going to be a smart move to make, and sometimes that move is to simply stay where you are and wait for the right time. My name is Alice Prince, and I will catch you on the next one. Ciao for now.